Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is another special edition of Market Guru. And our Market Guru of the day is also a very special person. Mr. Gautam Shah is with us, founder of Goldilocks Premium Research, to help us understand which way are the markets headed and what should be your key strategy now. Warm welcome to you, Mr. Shah, and thank you so much for taking the time out. You know, you're joining us at a very good time when the dust has settled on most of the major events which are now out of the way. We've had two budgets, one election already done and dusted. Half of the year has already panned out. I want to begin by first understanding from you, nearly that, that 25,000 mark remains elusive, but we just came in at the touching distance of that over the last two odd trading sessions. How are you looking at the market setup right now? What is the way in which the next 6 months are going to be panning out?
Hi, good afternoon, Sakshi. Thanks for having me. Well, I think the dust might have settled on the events, but the dust is yet to settle for this bull market, I think, which continues to be extremely strong, extremely resilient, and extremely mature. And the way the Indian markets have handled some of the recent events, local events in the form of elections and budget, and the way the Indian markets have handled the geopolitical events, the factors that we witnessed last year, and the fact that the Fed is delaying its rate cuts, I think it just tells you that domestic liquidity has taken over completely. And the way the markets have seen beautiful rotation across sectors and across segments is something, that's just propelling this bull market higher. I mean, look at the kind of rebound FMCG stocks have seen, in the last 6 weeks. It just tells you that the setup is extremely strong. So I believe that the trajectory is still up. The market is still headed higher. 25,000 does not have any real technical significance, even though it might be a milestone from a psychological point of view. And I think once this number gets crossed, you are going to see further upside. So the trajectory is still up. Expect more strength towards Diwali. In terms of numbers, I think 25,500 has been our working target. And if you think slightly more longer term, I think 28,400 is a number that we have been putting out in our reports. But the idea is to be in the right pockets, to be in fundamentally solid companies. Sectors like pharma, FMCG, chemicals, metals, IT. These are the names that we like. And I think banks could possibly make a very serious comeback over the next 3 to 6 months. So if that were to happen, I think this market is headed higher. One should still participate because I see every day people questioning this market. I haven't seen so much concern and so much fear at all-time highs, which just tells you that this market has a lot more ahead up.
Okay, that's a wonderful way to put it, and I will remember the dust is yet to settle on the bull market. So this is a market that you should continue to participate. We will build on to this, starting point that you've come out with, the key sectors that you mentioned, and of course 25,500 as your working target, and if that goes beyond 28,000 and above that. But I want to also address one of the things that has now happened over the last few odd trading sessions since the time the budget happened. There's one key portion of the market that has actually come under the regulators' radar, and that is the F&O space. Especially yesterday when the SEBI came out with their consultation paper, this space has again garnered a lot of attention as to how the steps that have been proposed by SEBI are going to impact the market volumes, because we've been seeing a lot of gush of liquidity. So is that going to be under risk? What should the fresh and new retail investors now look at building their further positions here? So I want to first understand from you, how are you really looking at the SEBI's tough stance on the F&O space, the 7 steps that they have proposed, and what is going to be the likely impact here?
Well, I'm not an expert in this area, but still I'll give you my 2 cents, given my commonsensical understanding to the developments. I think it's a step in the right direction, no doubt about it, because you don't want to encourage mindless speculation. And given how markets are, and given the fact that there are many new entrants to the market who have never seen a bear market in their life, it is only right for SEBI to take such steps so that people are aware that in difficult times it can really get very, very difficult. And what you have seen in the last 3 years is not something that's going to carry on forever. So in that sense, I think it's a step in the right direction to curb, mindless speculation. On the other hand, I think people also need to have a level playing field. So if you look at retail investors, not everybody does speculation out of F&O. I think there are a lot of people whom I know also who do a lot of hedges in the F&O space. Because if you have an event like elections, you take those hedges against your portfolio. So I think that should not be curbed, and it should be a good balance, so that retail investors and HNI investors are able to also hedge their portfolio on the FNO side. So I think one will have to, find the right path. It's just my thought process that both these aspects of the market needs to be considered.
Right. So, Mr. Shah, just to understand, the impact of that in terms of what should, what do you think could be the impact on the volumes, revenues of the broking companies? Are they at risk at all or no? Because we actually saw some dips over the last few days, but today again, they've managed to surge too much. I mean, like, BSE, CDSL, these stocks are up, higher up 7-8% in trade today. So, are they already absorbing this? Whatever, correction had to happen has happened already. How are they looking at these measures? Aren't they going to impact their turnovers and revenues?
I think it's still very early days. As the name says, it's a consultation paper after
Correct.
all. I think everybody is giving their inputs, and then SEBI will come up with a final policy, and then we take a call. But one thing is very clear that this financial services theme is here to stay for the next 5 to 10 years. We waited 20 years to see domestic liquidity take over the Indian markets. 2 decades, because the last bull market was led by foreign money, led by FIs. So in that sense, I don't think these regulations will stop the inflow of capital into the equity markets. It will definitely curb speculation, and I'm sure volumes will be hit. But will it impact the overall trend of the market? Unlikely.
Okay, got it. Now, beyond the SEBI measures, we have to see that how the markets will continue to move in, even if these steps were to come in. And of course, you have to work with the regulator, and the markets will adjust accordingly. And that's how we have seen how the markets have functioned all over the last few years. Now, you did say that you are positive about the strength that is still inherent in the Indian markets per se, the liquidity flow that will continue to go. You did talk about the few sectors which are going to be probably looking at the next flow of money coming in. But I also wanted to touch upon the earnings factor right here. We are amidst these earnings. How have you assessed the earnings thus far, and have you put in any fresh money to work amidst the earnings which have probably given you any limelight there?
Well, I think the market got into earnings season with very high expectations and with just no room for disappointment. And I think in that sense, we've actually handled ourselves really well. Because in the last 3 weeks, I think there have been some minor disappointments and there have been some minor adjustments. Some stocks have corrected. But in general, I think it pretty much validates the equity market, bull market that we've seen in the last 6 months. So I don't think there are any disruptions. There are any major red flags. So far, things have gone off well. And I think this will only help the market sustain these levels and move higher. But does it mean that the market will continue to move up in a vertical manner? The answer is no. I think we will grind higher. We will see consolidation phases from time to time. And historically, if you look at the PE ratios, currently we are somewhere around 23, 24. And historically, markets have topped out in the last 2 times was around 27, 28. So there is still room for some more PE expansion. I think that's going to happen. And any which way, when liquidity comes in, people somehow keep fundamentals and valuations, on the backside. And that's something that happened in the last bull market as well.
But is it getting incrementally difficult to find value in this runaway market, or do you think there is enough and more that one will have to now scout for?
So see, value is a historical term. I mean, if you look at value from what value was 20 years back, then you're not going to get your 5 Ps and 6 Ps and 7 Ps.
Correct.
But then if you feel that a 15 P is also value, then there is a lot of value in the market. So I think value also, I think, has gone few notches higher. So in that sense, I think there are still opportunities. In fact, why isn't an HDFC Bank a value stock? I mean, everybody talks about it as a growth stock. Honestly, I look at it as a value stock, and that's the point that we made a few months back, that HDFC Bank was available at the pre-COVID highs. So that's the kind of underperformance that it saw for 3 years, and we discussed this in the last interview. So I do believe there are still pockets in the market, like the move from ITC from 500 to 600, the move from Dr. Reddy's from 6,000 to now close to 7,000. The metal space looking extremely good, the Tata Steels of the world, the sales of the world. I think there is still a lot of value in the market, honestly. And on the other hand, if you look at some of the growth stocks, the typical growth stocks like an Asian Paints, they have been underperforming continuously.
Absolutely, that's an interesting take right there. But do you also spot any kind of risk in this upward journey within the markets that you're looking at? Since you did say that, of course, we are going to be probably looking at higher highs in, say, towards the festive season and Diwali. But do you see probably how the way the Fed moves tonight, or the way decisions are taking globally and domestically as well? Is that going to be some kind of a risk, or this event will also be digested just the way we've seen the previous events and will go on as a non-event?
Well, to be honest, if this was a budget which was presented a decade back, we would have been at lower circuit. And
Yes.
given the domestic liquidity, I think to just scrape through with a 1.5%, 2% dip on such major capital market developments,
Yes,
I think
yes.
was commendable. And I think that told me a day later that this market is still safe because we keep getting hit with these local and global developments and we still stand. So I think one does not need to overanalyze because we've come through such major developments. I think we are headed higher, and I don't see anything in the horizon, at least in the next 3 to 6 months, that could really, hamper this ongoing bull market. On the Fed, I think today they are going to maintain status quo, so nothing much is likely to happen. But their commentary on whether they are going to cut rates in September and October is something that we will be watched. And it's highly likely that they will cut in September and October. And if that message comes through, then I think a lot of pockets in the market, including financial services, will start to do well.
Okay, got it. So no risk as of now, and if at all, we'll have to be prepared for any unforeseen event only as a risk, nothing that you see on the horizon, right? Okay.
That's that's true. I think it's any risk has to be out of the box. It's not something that's visible in the current scheme of things because I don't think valuations is a risk. The only argument people who look at the markets from a different perspective talk about valuations, but that's been a risk for almost 18 months now.
Yeah, yes, very true. Now let's get down to understanding, your own selected pockets where you're looking at interestingly. So chemicals, pharma, FMCG, metals, IT and banks is what you've pointed out that these are going to be interesting points. Any key stocks that you've identified from here, or would you go with the leaders? Would you go with the mid caps? How are you strategizing within these pockets, and how would you advise the retail investors there?
See, the traditional defensive names, as they call it, which is FMCG, pharma, and IT, have actually
Yeah.
been the best performers since the election day results.
Yes.
And I think that's the space where I want to be in. I mean, ITC, I think, could do wonders even from here. So we remain
Okay.
a big bull on that stock. So ITC and HUL are right on top of our list. Followed by, if you look at pharma, I think stocks like Cipla, Dr. Reddy's, and Sun Pharma have a lot of room on the upside. I see the pharma index delivering 15% upside on the index over the next 6 to 12 months. So I think
Okay.
stocks will do better. In the IT space, I think TCS could be the big mover over the next 1 year. I wouldn't be surprised if the stock moves up by about 1,000 rupees. Now, that's a very big move for a stock like TCS. And it's
Yes.
coming out of a nice base of about 3 to 6 months. And it's TCS after all. There is the Tata angle and there is the IT angle as well. So that's another space that we like. And I think the dark horse once again for the next 1 year could be metals.
Okay.
It was our big call 8 months back. The sector did exceedingly well. Last 2 months, it's gone very quiet. Nobody's talking about it. But this is
Yes.
beautiful consolidation before the next leg up. So names like GSPL, GSW Steel, Tata Steel, Vedanta, SAIL, we like all of them. And I think they could deliver anywhere between 20 to 40% upside over the next 1 year. So it could be the standout sector of the next 1 year. And I would also want to add banks. I spoke about SDFC Bank. I do see it
Yes.
trading at close to 2000 at some point of time. SBI has been my favorite for the last 18 months. I do see that stock moving towards 1200 rupees. So the
Okay.
top banks, if you see all the names that I mentioned are all top quality.
Yes.
I don't want to get into grade B, C, and D in the mid caps and small caps when I can get normal returns in the large caps.
Okay, wonderful. So those are some of the names. What about chemicals? I think that is something that you haven't given us yet.
Yeah, so chemicals witnessed a phenomenal bull market in 2020 and 21. Obviously, there were so many stocks that became 5 baggers, 10 baggers, and 20 baggers.
Yes.
Thereafter, 2.5 years, it got into a phase where it did absolutely nothing. A lot of stocks came under pressure. And now we are seeing the first signs of a major breakout from this 2 year underperformance. If you see stocks like Deepak Nitrate, look at Aarti Industries, I think SRF trying to come back from the lows, PI Industries that we covered at Goldilocks on Friday. I think some of these stocks can deliver supernormal returns over the next 6 to 12 months. And again, I like the margin of safety because the earnings have been consistently good and the
Yeah.
stock prices have not gone anywhere. So the PE ratio has basically stayed where it was in the last 2 years or gone down. So in
Okay.
that sense, I think chemicals is a big opportunity for investors.
Okay, wonderful. Now, would you be also able to tell us, if the fresh money goes into these pockets for the outperformance that could lie from here, where does one book out from? Where are the pockets where you do believe that, a lot of run up has happened and probably this is the time next 6 months, nothing much is going to take place and one should actually shift the money out and put into these sectors, because that's how you've highlighted the beautiful sectoral rotation that has taken place and that one should take advantage of so far.
Yeah, I think that's a good point, and I think that's a challenge where to take the money out because everything seems to be doing well. It's just that some sectors will take a bit of a backseat, like what real estate has done. If you actually look at it, DLF has done nothing for 3.5 months. It's been around the same level where the markets and
Yes.
the sectors have done. So I would say real estate, capital goods, auto, and select PSU. These are the four baskets where one profits because you've seen a supernormal move there and almost a vertical parabolic rally there. Take profits there even at the cost of losing the last bit of the rally
Right.
and move to some of the the ITCs and the TCSs of the world where I think the margin of safety is good that if tomorrow there is a global development and if the markets go
Yeah.
through a 15% correction, you know that you are in safe stocks.
Okay, that's a wonderful way to put that. How about the defense railways space? Within that also, of course, you did talk about a basket PSU names. Defense railways also come under the same basket?
Yeah, it does come on the same basket, but you have to be
Okay.
very specific because in the railway space, I would still bet on an IRCTC. I think it's probably one of the better proxies. I know it's not done as well, but at 1,000 rupees,
Yeah.
there is not much to lose. Secondly, RITES is another stock that we've been liking. I think there's a big a theme that's playing out for that stock as well. Again, you have to have a 2 to 3 year sort of a
Sure.
mindset. So there are some very selective names in defense and railway which will do well, but I think the madness will stop or has already stopped.
Okay, got that. How about this insurance space that has suddenly seen a lot of traction over the last 10 days odd? Stocks like SBI Life, HDFC Life, they're always in among the top movers within the Nifty or maybe even in the FNO space. LIC is coming back to newer highs. How are you looking at this entire basket?
See, at Goldilocks, we make custom indices. Sometimes what NSE does not give us, we make our own index. And that gives us a sense as to what certain pockets of the market are doing. So last month, when we released our sector trends report, we put out a custom made insurance index of about 10, 12 stocks. And we
Okay.
realized that the 2.5 year underperformance of this sector has come to an end. I mean, look at an SDFC Life. It's finally trading at levels of 700 and above. And we've been discussing SDFC Life for 3 years now. So I think insurance as a pack is back. I think there is more upside. I think ICICI Lombard has been our top pick in the general insurance space, and ICICI Pru and SGFC Life would now be the top picks going forward. And MFSL is probably the star performer of the sector and should do very well over the next 2 to 3 years. So I think we like this entire space, and there is clearly a lot more catch up which is now going to play because they need to cover up for 2 years of underperformance.
Yes, absolutely. Well, fantastic speaking to you, Mr. Shah, as always. And thank you so much for taking the time out for our viewers yet again on Business Today Television. And we're hoping to see you back very soon on another edition of Market Masters with us. Thank you so much for being with us on this special edition on Market Today and on Business Today Television. Viewers, we'll wrap it up at that. But do stay tuned as a lot of interesting conversations will continue to follow suit from the earnings space as well. So don't go anywhere. Business Today Television is where you should be.
नमस्कार गौरांग जी, स्वागत है आपका। सबसे पहले ज़रा चर्चा करते हैं किस हिसाब से आप इस सेबी के इस कंसल्टेटिव पेपर को देख रहे हैं, जहां पर लगाम लगानी चाहिए वो ना सिर्फ लगाम कस दी गई है, लगता है सांस भी आनी बंद हो जाएगी। आप खुद जियोजीत फाइनेंशियल्स का P&L अकाउंट हैंडल करते हैं, ब्रोकर्स पर क्या असर पड़ेगा, रिटेल इन्वेस्टर